Assalamualaikum and a very good day to all viewers out there. Welcome back to my channel. In today's topic, we are going to talk about intra-group transaction under the group consolidation issues. And in this presentation, we are going to focus on intra-group sale of current asset and elimination of unrealized profits. I will be explaining an illustrative example in the case where parent is the one that sold goods or sold asset to subsidiary in this video. And the following video will be explaining an illustrative example on the case where the subsidiary is selling goods to the parent. And for your information, if that happened, that was intra-group sale. For intra-group sale of inventories, I will start off with explaining to you the nature. For your information, a parent or a subsidiary companies or any members of the group may sell or transfer asset like inventories to the members within the group. So the buyers are still within the group members. If this took place, this is what you call intercompany transaction. For example, let's say the parent is the one that is selling goods to this subsidiary, and this subsidiary is, let's say you call them subsidiary 1. So if this happened, this intercompany transaction happen because the transfer of goods are between the seller, the parent, and the subsidiary. Or it can also be the case where that is called, the first one is called downstream sale, where parent is the seller, the subsidiary is the buyer. Or it can also be the case of the subsidiary is the seller and subsidiary is the one that are selling goods to the parent, and this is what you call the upstream sale. In both situations, these will give rise to what you call intercompany sale of trading inventories. So what would happen if you sell goods to your customer? Normally when you sell goods to your customer, you will sell it above the cost price. So if the customer, even though it's the between group members, you charge them some profit on your sale of goods, and let's say the goods are being sold still remain with the customer. Let's say you have an inventory balance. You are the parent company and you have some balance of 3,000 in your account. And on the same, let's say somewhere in the current year, you decided that there will be a sale and the seller, you are the seller, remember, the buyer is your subsidiary company, and that say the goods that were being sold cost you 1,000, and meaning that you don't sell it all, you just sell some of it, and there are some unsold inventories in your books. And let's say that was being sold off for 1,200. It means that you have charged a profit of 200 because the cost of the goods were just 1,000 and you charge a profit of 200. How you decide this 200? It can either be based on markup or margin. Right. In your books as a seller, and I'm saying here that you are the parent company. So in the books of the seller, you are going to record this when the sale took place, debit trade receivable with the subsidiary's name and credit sales. That is because you are selling goods. To the subsidiary company, that is a purchase of goods. So they will be debiting their purchase account and they will credit the supplier or the trade. The supplier here is you as the parent company. So the name of the seller will be here. So 1,200. And this is an intercompany transaction. And it gives rise to financial asset as well as a financial liabilities. And this is an intercompany credit sales or an intercompany credit purchase. So let's say in the buyer, which is the subsidiary, the good that was sold were not being sold off to the outsider. It was sold and it still remained in the books of the buyer, remains unsold. It means that in the books of the buyer, there are some closing inventory worth 1,200. Remember earlier, the seller has charged a profit of 200 on that goods being sold off. So the profit that were being charged is what you call unrealized profit, because this is the goods or the profit that was charged as a result of an intra-group transaction, or more specifically, this is an intra-group sale of trading inventories. And the unrealized profit of 200 that arise on this intra-group transaction, either being sold by the parent or either being sold by the subsidiary. It does not matter whether it is an upstream or a downstream sale. Regardless whether that is the case, that must not be reported in the financial statement. It's a big no. It shouldn't be reported. It must not be reported. And because earlier it has already been recorded in the individual separate financial statement of the parent and the subsidiary, this must be eliminated. Not only the trade receivable balances, which relates to the 1,200 that still remains unsold. If let's say you purchase 1,200, the one that was still unsold was let's say 1,000, the figure here may not be 1,002, it may be 1,000, depending on what is the closing inventory. So what you refer here is the closing inventories or the amount unsold, right? So that was on credit. So we need to go and eliminate that. Not only that, that gives rise to a profit. Earlier you record, this is not an elimination, this is just the individual record. So because what happened in consolidation is that the principle of prudence or realization only allow recognition of profit should, let's say, the parent sell goods to the outsider, the one which is not the subsidiary, or maybe the subsidiary itself sell goods or bought goods from outsider or the third party. That is going to be recognized because they are the parties that are outside the group. It means that the profit that can be recognized are the profit that are sold to the parties outside the group. If the profit are recognized among the group members and the goods that are being purchased or the assets that are being purchased are still unsold or remains in the closing inventory or in the books of the buyer, that simply means that you have already recognized a profit earlier. So that profit that you recognized earlier may have to be eliminated, assuming as if the transaction has never taken place, and it will be eliminated. So the first elimination that you should do is the elimination of unrealized profit. Remember the 200 here, it may be based on markup or based on margin. Retained profit of the seller, the parent. So it also needs to be reflected in the inventory, because inventory of the buyer, which is the subsidiary company here, must be removed with that unrealized profit. There should also be elimination of intra-group balances, since the amount that were being acquired were not yet paid, or the amount is still owing from and to each other, right? So the trade payable that was earlier credited must be debited, assuming as if that has never taken place, because this is just giving you the net effect of zero actually. And it also need to be credited to the trade receivable to remove that balances which relate to group members. With the 1,200 that relates to subsidiary 1. Okay, you can have a more detailed explanation regarding what I have explained by reading these notes that are available here. You can take your time to screenshot the notes, and these are actually from my reference, which are from the textbook Company and Group Financial Reporting. You can refer to chapter 12, notes 12.1, page 432. The books that I'm using is the book by Jane Lazar, which is by Pearson. You can also self-study the example available in the textbook, which is at page 433, and example 2, page 436. But this is the explanation to what I just mentioned. You can also read further on this, which I also have mentioned to you regarding the unrealized profit, where the provision for the unrealized profit should be adjusted and should be deducted as an expense, where to you will remove in the retained profit of the member companies that sold the asset or the selling entity, the seller. And this apply for both, not only the sale of the current asset, like our case today, trading inventories, but also applies to the case of non-current asset, maybe the PPE, etc. Right? Only that for PPE, you may need to adjust for depreciation. The asset, for example, inventories of the buyer must be adjusted, as I mentioned. It should be done by deducting it. How? Credit that with the amount of the PUP, like what you read it earlier. And in some cases, it may also involve, like what we just discussed earlier, on the case of sale or purchase of goods on credit. And at the end of the year, where there are some balances that available in the trade receivable or trade payable that remain unpaid by the buyer, so that has to be adjusted as well, removed as well, cancel off. And the intra-group amount owing that were being eliminated, the reason is because it must not be shown in the consolidated financial statement, because it is also an intercompany group balances, which is an intercompany. It arises due to the intercompany transaction. And the profit that should be reported are just between the sale that took place or the buying that took place between the group members with the outsider or the third parties, or either that group member is the parent or the subsidiary. Okay, to calculate the provision for unrealized profit, you may have to use some of your knowledge regarding markup and margin that you may have acquired in your earlier studies or in your subjects that you are taking relating to costing, management accounting, or where you have learned about markup and margin. Markup is actually a cost plus the profit, which is what you call cost plus, where the inventories are expressed or being calculated when it is unsold, and you need to calculate the profit based on the unsold inventories using the markup percentage. You can look at the example because I will illustrate that, and you can also read the textbook regarding this, any relevant textbook on markup and margin. Next is the margin. Margin is simply percentage of profit expressed based on the selling price, or when that is a profit, which you have the selling price, and the profit here is expressed as a percentage of selling price. And I'm going to illustrate what is margin, what is markup. If this is 20% is the margin, so it would be 20 over 100. If this is 20% of markup, so it would be 120%. Okay, and that will be calculated to get the unrealized profit based on the unsold inventory. So go and have more reading on that. We go to our example, which is the example 1, illustrative example 1, the case where parent is going to be the party that sell goods to the subsidiary. So we have this information where I have taken an example from an old final exam that has been edited and being adjusted to suit the current accounting requirement. And I have extracted some of the information and amend where necessary. You have the statement of financial position of the separate parent and subsidiary. Focus your attention on the account receivable, inventory, and the accounts payable, and also the retained profit. And later I will go into that information that I mentioned. So these are the additional information that you need to look. And first one is regarding the acquisition of ordinary shares and the pre-acquisition reserve balance available on the date of acquisition 1st of July. And in this question, the non-controlling interest was given and measured for you, which is the one on the date of acquisition, 350,000. So you can cut short this example so that you don't have to calculate goodwill, since this will not affect calculation of goodwill when we deal with unrealized profit and cancellation of any intra-group balances. The information that is relevant from this question is this information 4, where it talks about account receivable information, and also information 8, which mention about the intra-group sale of trading inventories. We'll go into detail of each of this additional information 4 and 8. Okay, we are going to first information 4. Information 1 is just on acquisition matters. So you have this summarized statement of financial position of Lily and Rose as at 30th of June 2011. And you are given the statement of financial position, and of course this is what we have done much earlier. So as I said, focus your attention on the account receivable and inventories figure. So in our example here, as I mentioned, the parent is the seller. So Lily is the parent. So Lily will be the one that sells the goods, and Rose is the subsidiary company, and Rose is the one will be the buyer. So to confirm that, you have this information: account receivable of Lily, which is this figure, the figure there, 125,000, also includes the amount due from Rose. So in this 125, there are some 20,000 which relates to Rose. So this is the intra-group transaction, IGT. Okay, then you know that Rose is the buyer, so you have identified who is the buyer. This includes amount due for inventories costing 6,500. In this figure as well, it also includes some 6,500 which relates to goods in transit. How do I know? Because this amount that is due for inventories, 120, was sent by Lily. The payment was sent, right? The goods were sent, to Rose, but it was only received on 2nd of July, which is after the reporting date, 30th of June. So that will give rise to goods in transit, right? This 6,500. So you need to go and take into consideration this figure here and the figure here. Okay. So account receivable of Lily, amount due, right? And the amount received after the due date. So you need to eliminate two things here. One is the intra-group balances of account receivable, where account receivable was 20, 6,500 was due to goods in transit. So the account receivable balance of whom? Account receivable balance of Lily. So if it's account receivable balance of Lily, it has a debit balance, right? So now you need to eliminate. So you will go and credit 20,000, and that has to be reduced and assuming as if the goods that were delivered has reached you, right? That was discussed in my previous few videos that you may have checked and noticed. When goods in transit is, what we do is that the elimination must be done to assume as if the goods has never been delivered, right? So has already received, has received the recipient, not never been delivered. We assume as if the goods have already been delivered. I rephrase that, and it has reached the recipient, and that is why you debit the goods in transit. And the accounts payable balance must be adjusted. We are looking at accounts payable here of the buyer. It must be adjusted with this 13,500. And that must be removed because accounts payable, as you know, it has a credit balance. So to eliminate, you will eliminate by debiting it. And at the same time, as I said, you also recognize the goods in transit because you assume the goods that were transferred or were sent by Lily has reached the buyer, even though it has not, because this is for consolidation purpose. We will assume as if the goods have reached the recipient. That's 6,005 and to 20,000. The difference between that figures will be the amount that you will have to debit to your accounts payable rows. Rows is the buyer. We move on to the second adjustment that relates to unrealized profits and intercompany sale of inventories, where parent is the seller. Again, parent is the seller. So go and focus on this information regarding inventories, receivable, and accounts payable. These are the information that I have reproduced here. Half of rows Berhad inventory. So go to the inventory section. This is rows, right? Rows. So what you would need to know is that in rows, half of it, just get my pen, half from this 84,000 were purchased from Lily. So Lily again is the seller. Rose again is the buyer, is the parent that is the seller here. And it was invoiced at cost plus 25%. So half of the inventories purchased from Lily, and it was invoiced at cost plus 25%. And this is telling about markup. The word cost plus 25%. So the markup was 25%, cost plus 25%. So the markup is 25 over 125. 25 over 125. And this amount is still owing. So meaning that the goods were purchased on credit, and half of this amount, which is 42,000, half from 84, that was still owing. And therefore that will need you to make another adjustment or elimination for the intercompany balances of account receivable and accounts payable. Account receivable and accounts payable. Account receivable and accounts payable. So account receivable here will be the account receivable of the seller. Accounts payable will be the accounts payable of the buyer. Okay. Now, what do you need to do? Okay, when you read the sentence, just quickly go and identify who is the seller. So the seller is parent. The buyer, of course, the subsidiary. Identify the third one is the unsold inventories. So if you have the first sentence here, it is telling you regarding the unsold inventories. From the goods purchased, half which were invoiced still owing, and half of the inventories that you have here is still the one related to the one purchased from Lily. So it was unsold inventory that you reported here. So the unsold inventory was 42,000, half from 84. This half here. Next, you need to identify the unrealized profit. Unrealized profit, here you are given the markup percentage. The markup percentage, where the markup is cost plus the profit percentage. So 25 over 125 from the unsold inventory. So to go and calculate the unsold inventory and just straight away take the markup. 25% here means 25 over 125. 125 is 100 plus 25. So you have 8,004. Now you can do your journal entry here. So the elimination, the first one here is for elimination of the intra-group profit or elimination of the unrealized profit. Elimination of the unrealized profit in the seller. Seller here is Lily, right? So debit retained profit of Lily. So that will need you to adjust in the schedule of group reserve and the non-controlling interest, the analysis of the financial statement, credit the inventories of the buyer with the same amount. And you credit, you will be adjusting later in the consolidated statement of financial position. The current asset which relates to inventories must be removed or eliminated. Next is the figure relating to elimination of the intercompany balances of accounts payable and accounts receivable. Remember, the seller is Lily. The buyer is Rose. So in the accounts, in the Lily's balance, right, it will also include the customer, which are not just other customer, it also includes Rose. So the customer which relates to the subsidiary must be eliminated. So you will credit account receivable Rose. Remember, Lily is selling. So of course the customer, the subsidiary, right? So Rose 42,000, which is the amount owing or the intercompany balances of account receivable. And the same thing, so you adjust here. And you also need to remove 42,000 from the accounts payable Lily, half of 42,000. So you need to eliminate the amount owed to Lily because Rose has not yet settled the amount, right? So to Rose, Lily is the accounts payable. To Lily, Rose is the account receivable. However, that transaction must not be reported because they are intercompany transaction. So that will be adjusted in the current liability for the elimination of accounts payable. The elimination of accounts receivable will be adjusted in the current asset indices of P. So let's look at the impact of that in the schedule. So as usual, you will have to start by go and construct the schedule to compute the group reserve and NCI. Our focus is to look at the impact of the unrealized profits. It depends on who is the seller. If the seller is the parent, the unrealized profit will be adjusted in the retained profit of the parent. Retained profit of the parent here, which reflect the group retained profit. Group retained profit. Lily is the parent. Group retained profit, which refers to Lily's column, and also retained profit of Rose. So what you need to do is just put the balance as per the given in the statement of financial position, the one as at the reporting date. Go and check the balance. If you check the balance, it will be 125. Go and check that. Let us check here. Retained profit is having 125 for the subsidiary, general reserve 50. That is the figure. And 410 for the parent, 130 for the parent as well for the general reserve. Okay. Here is the figure, right? Next is to look at what is the pre-acquisition reserve balance. Do you have a credit or debit balance? In our case, I have put the information number 1 here. The retained, the figure that you have at the date of acquisition was a retained loss. So retained loss must be added back, right, to the balance available as at the statement of financial position date given, and therefore that post-acquisition balance was 145. So this does not have any impact for the unrealized profit. This is just computed, right? In case you have any adjustment, make sure you adjust those items first. Let's say you have other adjustment that will affect the retained profit of Rose. Go and add or minus that first, and that after that adjustment, the post-acquisition balance, which is adjusted post-acquisition balance, here is still 145. You will go and segregate between what will be distributed to the parent, what will be distributed to the non-controlling shareholder. Since the share of the group or share of the parent is 60%, so the retained profit of 145 will be multiplied by 60%. So you get 87. And 58 here is 145 minus 87, or 58 is 40% from 145. Okay, that one is no problem. Let us look at the column for the group reserve, which is group retained. RP is retained profit. Lily is the parent. So the balance as per soft P, I'll show you again, is 410. 410. So the unrealized profit was earlier debited in the retained profit of Lily. Debit retained profit Lily means to go and minus or deduct here. Okay, you will go and take 410 deducted with this, plus the share of profits in the subsidiary. So you have the group retained profit to be 488,600. For the general reserve of rows, the balance as per the statement of financial position is 50,000. This balance 50. And the balance on the date of acquisition was nil, no balance. So the post-acquisition balance was 50,000. You will go and distribute them to the group parent company. 30,000, 60% from 50,000. The workings are here. You can show the workings at the outside section. And 20,000 is the non-controlling interest. Do not forget the non-controlling interest was given to you here. The non-controlling interest on the date the shares were acquired was 350,000. So you will total up this. You get 428, NCI, general reserve 160. So these figures in yellow box here is the one that will be transferred to the statement of financial position for the group, or the consolidated statement of financial position. So you have this, the title there, the current asset section, what you have journalized earlier in your consolidation journal, you go and add it or minus here. So what you add to the inventories will be what you debit to the inventories will be added, what you credit to the inventories would be deducted. So you have your earlier section, the first entry, in case you have forgotten, I'm going back, right? This one, goods in transit, 6,005, you debit, so it will be added to the inventories. And another one is the unrealized profit. So the unrealized profit will be also adjusted. I put here PUP, which stands for provision for unrealized profit, 8,004. So take 163 is the one under the parent inventories, subsidiaries inventories, the goods in transit, you debit, so to add. You can also create this account separately, but I would suggest you to do it in inventories itself, minus the unrealized profit. So you have 245, 100. Account receivable, you will just add the parent and the subsidiary, adjust for the intra-group balance 20,000, which is from adjustment 4, adjustment number 4, and also go and minus the adjustment item number 8, number 42, number 4 is from our information 4. You have 143. Okay, the rest are just a matter of you taking things from here. Group reserve 488,600, this one. Group general reserve, you just copy and paste it here. Non-controlling interest, you copy from the column and paste it here, right? This is a separate item. And the last one is the current liabilities. So the adjustment for current liabilities is for the intra-group balance, which is info number 4 that we have discussed earlier, and the amount owing of 42,000, which relates to the cancellation of the intra-group balance, which is relating to trade receivables and trade payable. This adjustment here again. So when you debit, you go and remove. When you credit account receivable, you also go and eliminate or cancel off. Right? That's it for this discussion of example 1. You may just keep in touch with me, because I will continue doing example 2, which will discuss on the situation that the parent is the buyer and subsidiary is the seller. With that, I thank you. I will be using the same question, but I will just make some amendments for the second example. Thank you for watching. I'll see you when I will see you. Assalamualaikum, and have a pleasant day ahead.